Okay. All right. Fair enough. Hey, Caitlin. Hey, Caitlin. William. Welcome. I was just telling Brianna if she has any. We could wait for others to join, or you could just start asking questions if you have them right now.
Kind of was willing to more listen into
Okay.
um, what other people had to offer.
All right.
I was just doing some homework problems right now
All
from the
right.
other past chapters. I was wanting to see what people had about trouble on some stuff.
Okay. Fair enough. Caitlin, do you have anything you want to start with?
Yeah,
Okay.
I was rereading the book. It was for chapter 5, the stock market
Uh huh.
chapter. I could not understand how to find the price when there's a market buy or market sell.
Okay.
Which I'm sure is really easy and I'm just wrong.
Well, let's see. I've got a hard copy of the text here, or do you, maybe here? Actually, let me go. I opened up a connect window here, but let me open up another one. Oh, I take that back. I'll just stay in that one. Da, 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 da. Where did that go? Nope, wrong thing. Nope. Let me get back to wherever I was. That's weird. I've got too many tabs open here. Sorry about that. Where did it go? Where? There's. Oh, there it is. There it is. All right, so chapter 5. Let's just go straight there. Sorry for the background noise. I left my windows open and we're right on Shaker, so if you hear traffic, that's why. Okay, so you were talking about buying and selling?
Yeah, so when there's a market buy or a market sell order
Uh-huh.
that's filled.
Let's see if I can find the spot or at least get close to it. Maybe here, special order types. Does that ring a bell at all?
Yeah.
Okay. Let me increase the font size here so it's a little easier to see. All right. So now, and I don't want to repeat things that you're already familiar with. Is it maybe this paragraph here that they're talking about? Ticker symbol KO. What is that? Coca-Cola, right? So you check the terminal screen. Is that the area that you're thinking of?
Yeah.
Okay, great. So let's see. Upon approaching the post where KO is traded. Now, mind you, this is kind of referring to the physical floor of the NYSE. So each DMM would have a particular spot that they're stationed, and traders know if I want to trade Coca-Cola, that's where the DMM for the Coca-Cola is. So they would go to that area. The screen reveals that the latest executed trade for KO was at, pardon me, 46.63. The current bid is 46.55. You could immediately sell at 46.55, but that would be too easy. All right, so let's talk first about the bid and the last price. The last price is whatever the trade was that just occurred, but the DMM is going to be quoting a bid and an ask. All right, and remember the price of the bid is the lower number, the smaller number. The ask is always the larger number. And the bid is the price that the dealer buys, so bid and buy. So if you are trying to sell, then you would be selling to the dealer's bid, because that would be the dealer buying, that would be you as an investor selling. So that's where they come up with that 46.55. Since the bid is 46.55, that's what you would sell at. Now, the reason that the other price, the 46.63, was the last trade, it could have been a sell or it could have been a buy, but the prices have moved since that last trade. So one thing we never know about is, did the last trade occur a millisecond ago, or was it 2 hours ago? So it could be that, that was also a sell at the bid, but now the bid has decreased down to 46.55. Or it could be that it was the ask, that someone was buying at that price, and maybe the spread is very wide. It's between 46.55 and 46.63. That could be the lower price is the bid, the higher price could be the ask, and that could have been an order to buy that just occurred just a millisecond ago. All right, so let's see. Instead, as the customer's representative, you're obligated to get the best possible price. It's your job to work the order, and your job depends on providing satisfactory order execution service. You look around for another broker who represents a customer who wants to buy KO stock. So again, remember the customer, if you're the customer, you're a seller, so you're looking for a buyer. Luckily, you find another broker at the post with a market order to buy 20,000 shares of KO, noticing that the price that the posted asking price is 46.71. You both agree to execute your orders with each other at a price of 46.63. This price, halfway between the posted bid and ask price, saved each of the customers approximately 8 cents times 20,000 shares, or $1,600, as opposed to the posted prices. Now, what they're referring to here in this particular example is what the NYSE would call price improvement. So what they say, and you can read this on their website, one of their rationales for why you should list your stock on the NYSE and why it's a better venue for trading, is that you might see a posted bid and an ask price, but there's a potential that there's a price improvement, meaning that you get a better price a higher price if you're selling, and a lower price if you're buying. And this is an example that they're giving that kind of makes the point of how a price improvement would work. You don't necessarily have to trade with the DMM, the designated market maker. You can trade with another party, even on the floor, and if that party has a better price, you can make a trade at that price. This is I'll be honest with you, this is a rather convoluted explanation of that process. And so I think what I would say, as long as the primary things you want to be able to know about are what's a bid price, and which transaction would you face the bid at, and likewise about the ask. And then you want to know the difference between the bid and the ask, called the bid-ask spread. And then you want to recognize too that the bid is always lower than the ask, and that as a investor, you're always on the wrong side of it. You're always selling at the low price, buying at the high price. And that should keep you in good stead on the exam. This example, like I say, is really kind of getting into the weeds and showing you how the NYSE serves its customers better than, say, another market might, or at least that's the NYSE's argument. Does that help?
Yeah, I think so.
Okay.
Yeah, I know, on the homework for chapter 5, there
Mm-hmm.
were I think it was one or two questions that had, a certain number of market shares, and then
Okay.
a table of
Sure. Let me go to the homework and oops, I just hit the wrong button. Sorry. There it is. And you don't happen to remember what number it was or near which number, do you? Oh, maybe it's right here.
Yeah, it's this one.
Okay. All right. Perfect. Let's take a look at it. All right. So you find the following order book on a particular stock. The last trade on the stock was 75.52. Okay. So buy orders, you've got it listed 75, 51, 50, 49, 47. So the best price on the buy side, let's see. If you place a market buy order for 100 shares, at what price will it be filled? And I have to apologize for the terminology they're using here. This is not necessarily the terminology I would use, but what they are basically saying is that the orders on the left, the buy orders, are bid prices, and the orders on the right, the sell orders, as they labeled it, are asking prices. Again, whoever authored this is making a little bit of an assumption, especially to somebody who this is their first exposure. But you could relabel that as bid and ask. Bid on the left, ask on the right. So the dealer price, the price at which the dealer would buy at, are those prices on the left. So the best price for the dealer, or for you to so you would be selling. The best price for that would be 75.51. You want the highest bid price, right? And if you are a buyer, you want the dealer's asking or selling price. So you want the lowest number on that list, and that particular one is 75.54. So let me write this a little bit differently than how they have it. I don't know if I can write on this. I think I can actually. Nope, that's not what I wanted to do. What I really wanted to do was to change this to a PDF so I can write on it. And I can do that right here. Or not, I thought. Well, that worked like nothing. Let's try that again. I thought for certain maybe this will let me do it. All right, I'll try that. No, that's not it. I apologize. I thought I had the right one. Let me try markup. There we go. All right, now we're talking. All right, so let me rewrite this in the way that I would see it, and I will put it to you this way on an exam. All right. Here's how I would write this. So everything up above that line that asks, and everything below that bids is so anything below that line is a bid, anything above that line is an ask. These two numbers, this one and this one, represent what are called the inside quotes. meaning that it is the best bid price, the highest in that case, because remember, the dealer is buying. That means we are selling, so we always want the highest price to sell to. And in the case of the ask, it's the lowest asking price. In other words, that's the price that we would buy at, the dealer is selling to us. And so those two numbers represent where the market is when we do a market order. That is, we're going to face one or the other of those numbers. If we are a buyer, we will pay $75.54. If we are a seller, we would pay $75.51. And so in this case of A, so if you place a market order, a market buy order for 100 shares, at what price will it be filled? It would be filled at, oh, sorry about that. Let me turn that on to silent. That would be filled at the ask price, $75.54. So this dealer is selling, we're buying. If we go down here, if you place a market sell order for 200 shares, then of course we would face the bid price. The price at which the dealer is buying is the price at which we would sell. We're always doing the opposite thing. So that's the $75.51. And then suppose you place a market order to buy 300 shares. At what price will it be filled? Choose the appropriate number. Oh, and they give us number of shares. Okay, sorry, I didn't include that in my little write-up here. So let's see, we've got 200, oops, word. I must have changed markers. There we go. So we've got 200 shares here. We have 500 shares here. We have 1,000 shares here. 400 here, and I didn't write in the last one, 59, where we've got 750 shares. And then down here we have 250, 600, 900, and then 75. So the trick to this part of it is that the number in that far right column is what we call the depth of the market at that particular price. So the depth simply meaning these are the number of shares that are being offered at that particular price. So in the case of the ask, the inside quote right now is $75.54, and there are 200 shares available at $75.54. So now this question says, suppose you wanted to buy 300 shares. Okay, so buy, that means the dealer's selling, so we want to look at the ask. That's the first thing we need to determine. Second thing we need to determine is, okay, on the ask price, there are only 200 shares available at this price, but there are 500 shares available for a penny more. So we always start with the most favorable number to us, to our position. So we always start with 75.54 in this case, the lowest number. In the case of the ask, the highest in the bid. So the lowest number. So we wipe out that quote. And basically, that quote just totally disappears. Let's see, where is the eraser? Is that the eraser? No, here it is. That number, so we buy those 200 shares, and that just totally disappears. Now, the inside ask becomes this number immediately. The bid stays the same, because nobody has hit the bid, if you will, but the ask increases by a penny. And the spread also increases by a penny. Now there are 500 shares available at that price. We're taking 100 of those to complete our order. So again, this will, once we complete our order, that changes from 500 to 400. And now our order is complete. And so we bought 200 shares at 75.54, and we bought the final 100 shares of the total 3 at 75.55. So we got an average price of what, 74.54333, right? Is it $75.54 and a third cents? Because we bought 2/3 of them at the lower price and 1/3 at the higher price. Yeah, that's right, I think. Yeah. So that's how you answer that question. Does that make some sense?
Yeah, that's so much.
Yeah, and I'm glad you're asking this, because these can be, completely opaque when you're first seeing it. It doesn't necessarily make a heck of a lot of sense. Oh, so that's so part C. Let's just make up an example here. Let's say that we wanted to buy 500 shares, or excuse me, let's say that we wanted to sell 500 shares. So how would we figure out at what price we sell those shares? Let me pose that to anyone, actually, not just Caitlin. Brianna, William, welcome. By the way, welcome, Justin. How would you go about that? You're selling 500 shares. You want to figure out at what price you would get those 500 shares sold for. Don't everybody answer it all at once. Start it off, Caitlin, if you would.
Okay, so we would want to look at gas price.
Yep. Or no, sorry. Let me write up here what we're doing. Sell 500 shares. So we're selling. That means the dealer is buying. And always remember that mnemonic: buy, bid. So we're always going to be at the bid. That mnemonic will save you. I wish it worked both ways on the ask, but as long as you got one direction, as long as you know that the bid is always what they buy at, then you know the ask is what they sell at. So what do we get? What do we get for the first 250 shares? What kind of price?
So the first, so we would want the 400 shares selling at 75.
I'm sorry, 75. I didn't.
75.55.
No, that's going to be the ask, right? So that's the price at which the dealer sells. They're asking that price for it. And we want to sell, so that means the dealer's going to have to buy. So you want to be down here with the bid price. So let me walk through this with you all, because it sounds like it's not clear to anyone, actually. So starting here, we've got 250 shares, or we've got a depth of 250 at 75.51. So we're going to completely sell. We're going to sell our shares to the dealer, as many as we can at that price, because that's the highest price. So we basically we wipe out that quote. And remember, keep in mind that these quotes are basically the dealer, the DMM, out there saying, "Hey, this is what I'll sell for. This is what I'll buy for." So it's not unlike you walk into. Think about. I always like to take it back to something that we do more commonly. Walk into a grocery store. Okay. Now a grocery store only quotes one side. They only quote an asking price, right? So I want to buy a bunch of bananas, so it's 79 cents a pound for bananas. So they're quoting an asking price. Now, if they were to quote a bid price as well, we could bring in a bunch of bananas to them, and they would buy them from us for 59 cents a pound, right? And then they would turn around, put them on the table, and sell them back to somebody else for 79 cents. So if you take it back to something like a grocery store example like that, maybe that helps to make a little more sense of this. Because this is, like I say, this is something I've done for decades, but I remember trying to first learn it, and it was painful. So don't feel bad about any of this. It takes some time. And I think those examples where we take it back to something we do ordinarily make it helpful, or at least are helpful. All right, so now we've already gotten rid of 250 of the shares that we wanted to sell. That still leaves us trying to sell another 250 shares. So we see now that the next best bid price is this 75.50. So now that becomes the active bid price. So the inside quotes are actually these two numbers. This one, that's the inside ask. This is the inside bid. And that's why I reorganize this in a vertical column with the asks up above and the bids down below. So we're going from a low value all the way up to this highest value. And then we've got this line right here where the dealer, instead of buying, they turn around and they'll sell at a higher price. All right, so we're going to use the 75.50 to sell back the other 250 shares. So we've taken care of all of the shares. So that means that now we have wiped out 250 of those, so the depth changes now to 350, but that price remains still the inside bid price. Now, in terms of what we made, well, we sold half of our shares at 75.51. We sold the other half at 75.50. So that means our average selling price was 75.51.5. So if we wanted to figure out, okay, 500 shares, what was our total gross receipts from that? 500 times 75.515. That would have generated 37,757 and 50 cents. So that would have been the total gross sales that we generated by selling those 500 shares. Okay. Now we could keep going with examples like that. So again, if we were going to sell more shares, well, now we would be hitting this price again for the first 350 shares. Anything over that, it would drop down to this price down here. And conversely, if we were buying, we would still have 400 shares worth that we could buy at a price of 75.55. If we wanted to buy 500 shares, 400 would be at 75.55, and then the last 100 would be at 75.57. And this depth would change from 1,000 down to 900, and this quote would be wiped out. And then we would have a new inside ask. And it would be 75.57. So the inside quotes would then be this value right here and this value for the ask. Okay? Now, there's one more complicating factor, and I won't give you an example of this, but notice how we started off with a spread of only 3 cents. If you remember here, we had a bid price of 75.51 and an ask price. The best ask was 75.54. The lowest ask and the highest bid were those two. The difference between that is 3 cents. Notice how now, after we've done these transactions, all of a sudden now the spread has gone up to 7 cents. Well, here's what happens on the dealer's side. The dealers go, oh, hey, there's an opportunity to make more than our typical 3 cents on a round trip. Because remember, the dealer always buys low and sells high, so they're making 3 pennies each share they buy and then sell back at that higher price. Here, they're making more than double that. So a dealer is going to say, aha, I'm going to jump in here with a new quote, and I'm going to quote a price of 75.55, and I'm going to have a depth of 500 shares on that. So what we'll see is that these will start to fill in. Sometimes they fill in from the top, sometimes they fill in from the bottom, and sometimes you'll see prices, the average price moving as a result of new information entering the marketplace. Other times, if no new information comes by, then the middle, the bid, what's called the midpoint of the bid and ask could remain the same. But that's not really part of this problem. I just want to give you an idea of what actually happens in the marketplace here. So hopefully that helps.
Makes a lot more sense.
Okay, good, good. Other questions that you have on that or anything else? I mean, while we're in 5, I can pull up any of the other 15 questions if anybody has anything on Chapter 5. I'm going to delete that one so we can come back to here. Nothing else on 5? How about elsewhere? Got to be some questions out of maybe 6, valuation. How about on 3, on margin accounts? Wait a minute. I take that back. That's Chapter 2, right? Sorry.
You mind if I ask a question about the format of the
Yeah,
test?
sure. Sure.
Isn't it, you said mostly multiple choice with about like the math related problems along with the definition kind of terminology kind of problems?
Yeah. Yeah. Go ahead.
Okay.
Yeah, well, so what you're going to see is about 20% of the test will be, you'll see it in the quiz as one problem, but it'll be a matching problem. So I'm envisioning, I haven't finished picking terms out, but I think you'll have probably close to 20 terms, or rather 20 definitions. You'll have probably 30 plus terms to pick from. So that will make up 20% of the exam. So you're going to take and you're going to get those definitions, and then you're going to pick the appropriate term. The unfortunate thing about the way that Canvas does its quizzes, when we do paper exams, I can order those terms alphabetically, which is very helpful. Canvas, I don't know of a way to do that. It won't let me do those alphabetically. So you're going to have to probably scroll through all those terms, unless you're really solid on what term describes that definition best, right? So, but that will be 20% of the test. The other 80% will be multiple choice. About half of those, maybe a little more, maybe 60% of those will be problems, numerical type problems like you've seen in the homework, like they've done examples of in the chapters. And then the other half to 40% will be kind of conceptual / more definitions or combination thereof. You know, you need to understand a definition before you can answer the conceptual part of the question. So that's the general makeup of the test. Does that help, William?
Yeah, thank you.
Sure, you're welcome. What else? Brianna, Justin, you haven't asked anything. I know you were mainly listening, but did any questions arise that as we were talking about the chapter 5 stuff or about the exam itself? Anything?
No, not for me. I think I have a better understanding now, though, because
Okay.
you went over it. So thank you.
Sure, you're absolutely welcome. Justin, how about yourself?
Nothing really in chapter 5.
Okay.
I'm gonna look over some other stuff to see if I have any other questions.
Sure. Yeah, we don't have to stay here. I just thought since we were here, if anything else was there, I can pretty quickly get to anything else without. It's like my internet connection is pretty good. Connect is McGraw Hill, so they're pretty solid on their servers. Let's see. Trying to think if there's anything else that we should back up here. By the way, I think I'm pretty certain that I announced this, but just a reminder, if you're looking for other problems to practice on, down here at the very bottom of the list are some, I think there are 96 more problems there. So you don't have to look at them. It's a repetition of what you've seen in the homework. But if you just want to see a different version of it with slightly different numbers and that sort of thing, those are out there for you. And again, if you've got questions on any of those, we can always jump in there too. Let's see, what do we have here? Total dollar return. Calculate more about calculating returns. So this is starting out in chapter 1, of course. Calculating compound, average returns. And then variance and standard deviation, that sort of thing. Geometric returns. See, what else do we have here? We jump up to what might be margin stuff here. It's probably up here. Here's some questions on margin, either a margin long position or a short sale, which by definition uses margin. Anything there?
Is there any way you could make it a little bigger?
Oh, I'm sorry. Yeah, sure. Absolutely.
Thank you.
Sure. Yeah, this is a short sale. We could just walk through this if you want. So, Mark is short sold. Let me turn this into a PDF, just so I can write if I want to. There we go. All right. So Mark short sold 500 shares of stock at $12.50 a share. The initial margin is 80%, and the maintenance margin is 50%. The stock is currently selling for $9.80 a share. What is Matt's account equity at this time? Ignore margin interest. Thank goodness. We don't want to deal with margin interest. You won't see it on the exam, right? So just a reminder. All right, so what I always like to do, I start off with some T accounts here to set myself up. Assets on the left, liability and equity on the right. And a couple of things that come immediately to mind, right? When I know I'm in a short sale position, I always have to think about, what am I borrowing? In the case of a short sale, you're not borrowing dollars. That's a margin long position. In a short sale, you're borrowing shares. So I'm going to state my liability as shares, 500 shares. When I open that, I know that that was at $12.50 per share. So $12.50 times 500. At the time I opened this, that was worth $6,250. Okay. Now, I also know that when I order a short sale, when I tell my broker I want to short sell 500 shares at $12.50, my broker will immediately borrow those shares from another investor, sell them to the market, and that generates cash dollars that become part of the asset. So $62.50. The other piece we need to deal with is, what is our skin in the game? What is our equity in this position? Well, we're told up here that we have an 80% initial margin. So remember, margin, and again, this is another key thing that you should just burn into your memory banks. Margin is net worth or equity divided by value of the stock. All right. So we know that our opening was at 80%. So I'll put 0.8 on the left-hand side. I know that the value of that stock was $6,250, and then I can solve for X. So basically, if I just do that algebra in my head, it's 6,250 times 0.8. And that means that X is equal to, let me shift that out and I'll just write it in. X is equal to $5,000. So that's the amount that I need to contribute to my brokerage account for my broker to open this account. So let me write that down here. I deposit $5,000. That also shows up on the asset side. So now I can total up my assets, and I have $11,250 on that side. And of course, when I do the addition over here, I have the same thing. Everything is good. I like to write that out and get that set up right away, no matter what the rest of the problem says, so that I know my starting point. Now, I also know that the asset, remember, another key thing to try to remember is that in the case of a short sale, the asset usually remains constant. The only time that rule is broken is if there's a margin call, and then it will go up, or they'll just liquidate the account, depending upon what my answer is to the margin call. If I say, okay, I'll keep it open, I'll contribute more money, then the asset value goes up. If I say I've got no more money, close it out, then they just close it out and we're done. All right, so now I can look, okay, maintenance margin is 50%, and the stock is currently selling for $9.80 a share. What is Matt's account equity at this time? All right, so let's do another little T account over here. We know that we have $11,250 on the asset side. We know that we owe someone 500 shares, and now the price has dropped, and that is $9.80 per share. So at $9.80 per share, so 9.8 times 500 shares is $4,900. Then I go back to my tried and true assets equals liabilities plus equity, or equity equals assets minus liabilities. So I go up here and just kind of a scratch pad here. 11,250 is my assets minus my liabilities. 4,900 equals my equity account. So let me do that on the calculator. 11,250. So I end up with 6350 in equity account value. I hope that's what they came up with. Yes, it is. Good. All right. Like I say, I find the T accounts extraordinarily helpful to keep my calculations in order. And the key thing on a short sale is to remember that the thing you owe is shares of stock, and that's going to vary in dollar value as the price of the shares goes up or down. The value of that obligation will go up or down. In the case of a margin long position, what you owe is dollars, and what's denominated in shares is the asset side, and the value of the assets in that case will go up or down as the share price goes up or down, respectively. So that's, another problem you can certainly, I'm not giving away anything by saying you're going to probably see a margin example on the test or two, So you definitely expect to see something along these orders. Questions or comments about this one? Anything else?
So a short position.
Oh, I'm sorry. I missed the last thing you said there, Caitlin.
Oh, a short position just means that, like, what does that mean again?
Well, it means that you are trying to take advantage of an expectation that the price is going to go down, but you don't already own the stock. If you owned the stock and you thought price would go down, well, I could sell the stock now, wait for the price to go down and buy it back again. So I'd make money on that. But this gives you an opportunity without even owning the stock to take advantage of your expectation that price is going to go down. So what we can do here is we borrow shares from somebody who does own the stock. We take those shares and we sell them to the marketplace right now at that high price. And then if our expectation is right and price does go down, we buy them back at a lower price and we replace those shares to the person we borrowed them from. And again, just as with this bid and ask prices with the dealer and us being on the other side of, these are concepts that we don't ordinarily bump into in our daily lives. So they, now margin long position, hey, we bump into that all the time. You buy a car, that's a margin long position. You're long the car, and it's margin because you probably borrowed some money to buy that car. You put some of your own in it, but then you borrowed the rest to buy the car. So we're really accustomed to that kind of thing. But, do we borrow a car and then sell it to somebody else and then hope to buy it back later at a low? No, we never do that. So those are the more complicated ones to kind of wrap our heads around. So a little more practice on that is always a good thing. And like I say, I can't emphasize enough, T accounts really helpful here. I hope that traffic noise isn't too terribly loud. I should have closed these windows. I didn't. I should have realized it's 5 o'clock. There's a lot of traffic on Shaker Boulevard at 5. What else can I help with?
I was going through the questions earlier, and I don't know if it's like a huge. I just want clarification on the
Sure.
term.
Sure.
So a liquidating dividend is a dividend that.
Yeah, a liquidating dividend is one that you don't, and again, here's one that you don't ordinarily bump into. I would define a liquidating dividend as a dividend wherein the company has halted all business and is liquidating all of its assets. And then the final act that that company has is to pay out that value to the shareholders in the form of what they call a liquidating dividend. Is that the context of that? Was that in the chapter somewhere? I forget.
Oh man, I think.
I was going to say,
I was going through.
oh, go ahead.
I was just going through like some of the homeworks.
Oh, yeah.
I'm not sure which homework I was on.
Let me see if I can find something. I'm going to go into the text here. Because I just want to make sure I'm using the right context. Oops. Let me go back home. I'm just going to get into chapter 1 and then do a search. So I don't want to mislead you if the context is different than what I'm thinking of it as. And liquidating dividend, I wouldn't think it would be, because that's a pretty clear. Oops, liquidating dividend. Let's see, where is, let me go back to where that was. Oh. Where is that in there? I'm missing it. I didn't look at the, oh, here we are. Problem 1. Is that kind of the example? So let me do it with the font thing here. There we go. All right. J&J Industries will pay a regular dividend of $2.40 per share for each of the next 4 years. At the end of the 4 years, the company will also pay out a $40 share liquidating $40 per share liquidating dividend. So yeah, that example right there is exactly the case that I was thinking of when I defined it. So basically that means that this company has been in existence 4 years, and at the end of that 4 years, it ends its existence and pays out everything that it's worth to the shareholders. So, in answering this question, see, dividend of 240, the company will cease discount rate. What is the current value of the company? So here, what I would do is I would say, well, I know that I'm looking for, let me go to the markup. I'm looking for the value here at time 0. At time 1, 2, 3, and 4, I have 250, 40, my bad. 240, 240, 240, 240. And then the only other thing I need to confirm by going back to the problem is to make sure I know exactly when that liquidating dividend is being paid out. So they will pay a regular dividend of $2.40 per share for each of the next 4 years at the end of the 4 years. Okay, so now I know where that goes. So that 40 goes right out here at the end, simultaneous with that last dividend payment. So I could rewrite that one as just summing those two together, 42, 40. So those are my cash flows. Now I just simply discount this one at 10% for 1 year, this one at 10% for 2 years, 10% for 3 years, 10% for 4 years, add them all up, and that gives me the value of my stock today. So this is really very much think 312 or 521, whichever class you were in terms of this is the way I come up with time value of money, time value of a future sum of money. Does that help? All right. You're welcome. Anything else? Brianna, Justin, or Caitlin? Any of you have any other stuff?
I don't, but I also have to leave the Zoom, so thank
Okay.
you for going over everything with us. I appreciate it.
Sure, you're welcome. If anything else comes up, feel free to email, and I'll try to get back to you as soon as possible tonight.
Will do. Thank you.
You're welcome. See you, Brianna. Anything else, Caitlin?
I think I'm good.
Okay, all right. And likewise, if anything comes up, just shoot me an email, and I'll be monitoring email at least till probably midnight-ish.
Okay.
And if something comes up in the morning too, that's fine. I'll start checking in the morning, say after 10.
Awesome. Thank you.
All right. You're welcome. Have a good night.
You too.
Bye-bye.